Hey guys, this is Baeza and welcome to another episode here at the YouTube channel. And today we're going to have an amazing topic, and that's going to be basically the role of credit scores and how that affects you in lending. We're going to explain how credit scores work. We're going to go over how they impact your approvals, and then also how that affects your interest rates, as well as what can business owners do in order for us as entrepreneurs to have the best odds in getting approved for a loan. I know that all of this may sound very basic and may sound like something that we should all know, but guess what? Sometimes it's not. So having that said, you guys, if you haven't clicked on the like or subscribe button, make sure that you do that now. Make sure that you also click on the notifications button, and we will be doing way more topics that are appealing and that we can help you guys out. So thank you so much for your support, and let's go ahead and get started. So the first thing I want to tackle is really just credit scores and how they represent a borrower's requirement and credit worthiness based on your credit history and your financial behavior. When it comes to your credit scores, it is always very important to understand that at the end of the day, it's like a report card. We will be judged based on how much responsibility we've had. If we have $10,000 in available credit and we've used it wisely, then yes, it's going to be great, because at the end of the day, it's going to show that we have been responsible in being able to manage $10,000. But it makes a big difference when you have $100,000, $300,000 in available credit. The more available credit that you have, the more that you have in your credit report, lenders will see that how responsible you are, because now it's not the same managing $100,000 versus managing $10,000. So it's always very important to understand how that plays a role with your approvals and lending. The second part that I would like to discuss is really just the credit scores. They can range anywhere from 300 to 850 being one of the best, of course. They're still in the 700s, that's still really good. And the higher scores really just means that you're gonna have better credit worthiness, and the lower credit is going to be much higher risk for the lender. So the lender will more than likely not give you as much money, or if any, if you have a much lower credit score. The most that we've seen is probably like in the 500s, low 500s, but you know, there's definitely possibilities for somebody to go as low as 300. I'm not sure. I don't think I've ever seen anybody by 300, but there's a lot of great things that you can do to improve your score regardless of where you currently stand. Whether you're in the 500s, in the 600s, 700s, there's always something that you can do a little bit better just so that you can improve that. The third thing that I would like to discuss is really how the lenders use your credit scores to assess your borrower's risk, right? And determine whether they can approve you on the loan or not. When it comes to something like getting you approved for a loan, they will put into consideration your credit history. How long have you had these accounts for? Are they brand new? What kind of accounts? Are they more shopping accounts like Macy's, JCPenney, or some of these other retail stores that they offer credit cards? Or are they more of the bigger cards like Chase or Citibank or so? Because the type of card that you get also determines how strong that account is and how much responsibility really it weighs in on that. And also, you're making your monthly payments on time. Are you keeping your credit utilization low? That means that if you have $10,000, again, we're going to use a $10,000 example. If that's all you have in your credit, are you using the full $10,000 in order to pay off some of your debt or some of the other debt that you may have? Are you piling it off? Are you living off of credit cards? Because that's something that the lenders want to know. If they give you more money, how responsible will you be? We want to make sure that you keep your utilization as low as possible, preferably less than 30%. That means that if you have $10,000 available, realistically, you should only be able to use roughly around $3,000 or less. Anything over $300,000 is going to be a bit of a risk, because you're risking lowering your credit score just because you do that. The next thing is late payments and high credit card balances, and how how collection accounts really negatively impact your scores. When it comes to credit cards and being able to pay them off, that has way more weight than an actual loan. If you have your car loan or even your mortgage or anything of that nature that's already stable, like the payments are coming out always the same, yes, it does matter. Yes, it does help, but it's always going to be a much stronger suit if you show credit cards that you're paying them off on a monthly basis, because credit cards can fluctuate and credit cards are not as easy to manage than it is a loan. If you do have credit card debt, that you're paying it off on a monthly basis, that you're always staying on time and making sure that the debt doesn't get out of hand. And that's what the lenders are really looking at, making sure that you're keeping your utilization, like I mentioned, down, and everything goes in hand with keeping your scores up. The next thing is really how business owners can improve your credit scores by paying your bills on time. I know that seems pretty obvious. I think everybody should pay their bills on time. There are situations in which business owners can be a little bit late, whether maybe the business is not doing as great as it used to, or maybe perhaps there's something that came up that they need to invest in. No matter what, you gotta pay your bills, because the moment that you start having late payments in your credit report, that starts to impact your credit negatively, very, very bad. At the end of the day, you're going to need to fight really hard to get that inquiry out, to get the negative utilization out, to get that late payment out, that collections account that needs to be out. It just becomes really messy. You want to make sure that you're reducing your debt. You want to make sure that there's no fraudulent activity on your account. So if you haven't done so yet, you want to make sure that you register for a monitoring website and you can manage your credit. Look at your credit. Most of the time, you're always going to be able to set up reminders, notifications. If anything changes, if anybody puts an inquiry on your report, you want to be able to catch that ahead of time, because especially in today's day and age, fraudulent activity is at an all-time high, especially with AI coming up. I know I get emails that look very real, but they're not. They're coming from robots and they're asking for personal information like banking accounts. It's not the old-fashioned, hey, I'm the prince from Nigeria and I'm looking to give you, $10 million if you give me your credit card number. It's no longer that. People have become more sophisticated in trying to scam others. So it's very important for you to keep your credit reports locked whenever possible, and more importantly, be able to monitor it very often. Many of you guys, I'm sure that you might already have a software, but if you haven't, you can definitely go and Google online, like Experian credit monitoring websites and whatnot, and you'll get a lot of great value doing that. The other thing is lenders may use some different credit scoring models to evaluate your credit worthiness. So for example, it's important to basically understand the specific factors that each lender will look at. We have certain lenders that will only look at Experian. We have certain lenders that will only look at Equifax. We have lenders that will look at TransUnion. And there are certain lenders that care more about the score than they do about the history and maybe perhaps even the utilization. Some of our hard money lenders, they don't care too much about the credit utilization, the history. They care more about the score, because the score for them is something that they can actually put in their record, and ultimately, because it's backed up by real estate, then it doesn't play as much of a role as if you're applying for a credit card. If you're applying for a credit card, they're going to look at utilization, late payments, anything that has to do with your credit fingerprint, and all of that will play a role into what you do. Now, because of that reason, depending on what you're applying for, it is important for you to make sure that you have all your ducks in a row, right? If you're doing a HELOC, is your property upright? Do you have any late payments in your account? Is everything going according to plan? So you want to make sure that you look at each lender's requirements, and before applying, that you're 100% up to their standards. So the last part that I want to go over is really understanding how the impact of your credit scores will affect the loan approvals, right? And the interest rates. Because when you're seeking financing for your business, it is always important to know that if you have a 500 or even a 600 credit score, you really should not be expecting really excellent rates. I'm talking about you're probably in the double digits where it's in the 10% or higher, because again, you're building your credit. Your credit's not there. And so if you do have some options to get access to funding and you're in the 600 credit scores, then it is also important to consider that maybe perhaps this is going to be the best thing that you may get temporarily while you fix up your credit, right? because you don't want to go ahead and expect a 3% interest rate or even 4% interest rate if your credit score is in the 500s or in the low 600s. Not to say that it's not doable, because some lenders will not care about the scores. Like I mentioned, some lenders care more about collateral, some lenders care more about the money that goes in, and there are certain lenders that will not even care about the scores. They will still consider it, but it's not going to be a factor as to whether or not they will give you the money. But the interest rates are more than likely going to be very high. The higher risk you have, the more you're going to pay. It doesn't have to be permanent. You can always figure out ways to make it temporary. Work on your credit. Find a credit repair specialist. If you don't have one, there's plenty of companies out there. I know for our company, for our clients, we do have an internal team of underwriters, an internal team of credit repair specialists that will work on our files, and that way they'll work on them, fix them up, and then when they're ready for funding, they'll go through the process of funding. But again, everything is on a case by case, is not a one size fits all. There's so many different creditors out there that are a little bit tougher than others to get out of your credit score, but everything is doable. It's just going to take time. So we want to make sure that we strive to maintain good credit all the time, and we want to make sure that we strive to get really good rates. And so in order for us to be able to take advantage of the opportunities that this amazing country gives us, we want to make sure that we are at our best behavior. Pay your bills on time, make sure that you keep your debt to credit ratio low, debt to income ratio as low as possible. And I know that it's not always possible to do 100% everything, but do your best. And if you guys have any comments, make sure that you put them down below. And if you haven't done so, make sure that you subscribe. You click on the like button, the notification button, to let you guys know of our next video. If you have any suggestions on any topics, let me know. This is Jose Baeza. Thank you so much for watching this video, and I'll see you guys soon.